So I'm not sure if the other board members know, I know some of you probably don't know, but Rafael Cestero came a couple of years ago and gave us a very interesting presentation, and so we invited him back for a bit of an update. A former commissioner of HPD, he is currently the president and chief executive officer of the, I'm blanking, of the Community Preservation Corporation. Thank you. So over to you.
Great, thank you. Thanks for asking me to come again. I appreciate the opportunity to talk to you a little bit about CPC and the work that we do and the long history we have of working in neighborhoods around New York.
On would help. Just by way of background, as the chair mentioned, I did work at HPD, both as the Deputy Commissioner of Development and HPD Commissioner from about 2004 to 2011-ish, and have been in affordable housing in New York City since 1989-ish, so I've been around the block a bunch of times on this set of issues and in the city, and have kind of lived and breathed this my whole life. At CPC, we are a 45-year-old nonprofit affordable housing community development finance organization. We provide debt and equity for the development, preservation, acquisition of multifamily affordable housing in New York City and across New York State. We've invested over our 45-year history about $10 billion in New York State, probably 65% of that in New York City. And we continue to operate at scale in a partnership with HPD, but also in providing financing for many privately owned rent-stabilized buildings. So what CPC has been doing for many years, which I'm here to talk to you a little bit about today, is we do a point-in-time analysis of operating expenses. It is, as I said 2 years ago when I was here, it is not nearly as thorough or scientific as the work that the Rent Guidelines Board itself does, but it does provide some basis for comparison because our universe set is fairly large. We service over 500 loans in New York. Many of those are made up of projects that have multiple buildings in them, so it's not necessarily 500 buildings, it's 500 loans that have many more buildings in it. So I'll just tell you a little bit about kind of what we do, which is pretty straightforward and simple. We go out to all of our borrowers annually and ask for expense information. We don't receive responses from everybody, and then we compile the data and we look at trends in operating expenses. Where are we seeing increases? Where are we seeing things that are relatively flat? And then, frankly, we include that into our underwriting, and it affects how we think about long-term operations of buildings. You can see here kind of a comparison of what we do compared to what the RGB staff does. Clearly, the RGB's sample size is much larger than ours, and not only does, as you know, not only does RGB do a point in time like we do, but it does the longitudinal study. I think getting basically right to the point, our numbers and the numbers produced by RGB over the course of time have been fairly consistent. You can see some variations depending on the year, but if you take an average from 2007 to 2016, which is the last year that we actually have a full data set, the average change in total expenses in our portfolio was about 1.5%. The average change on a point-in-time basis, RGB, was 2.36, and then the longitudinal, looking at the same set of buildings over a period of time, which is probably the most accurate measure, is about 3.2%.
Do you mind if we ask questions?
Please, yeah, jump right in.
Any instincts as to why your numbers would look different, like fewer, I mean, just different reporting, fewer elevator buildings, anything jump to mind?
Yeah, I mean, we do a lot of small buildings. So we do small walk-up, five-story, five-floor walk-ups. And, we do not do a lot of, of the bigger elevator buildings. Most of our portfolio is going to be older stock. It's not new construction. About 80% of what we do is acquisition, renovation, preservation. Most of our portfolio has some sort of regulatory agreement on it as well. So there's an overlay of some level of public involvement. We don't do a lot in Manhattan. That would be another difference that I would point out. So I think there's a number of things that would show variances, and would explain some of the variances.
Kind of a related question. So when some of the owner representatives from some of the trade groups came to testify, they said that one real big gap in the RGB data is that because we don't have data on the 1 to 10 unit buildings, we're really missing what's happening to that population. And they made the argument that perhaps that population is suffering increased costs more rapidly than the larger buildings. We looked a little bit at what the small co-ops and condos did. We also heard from somebody from that trade group, and I didn't see any evidence of that from that co-op and condo data. Do you have a sense of, do expenses go up more or less quickly in small buildings versus large buildings?
I think our view, we actually, I should have brought some for you, but I can send them. We did a deep dive into small buildings, and we produced something called what we call the Small Buildings Guide, which is a tool for small building owners to help them think about the operations of their building. What I would say, because we don't have necessarily any hard data on that question, but what I would say based on our experience and my experience is that smaller property owners tend to have a harder time controlling expenses because the buildings are smaller and they don't necessarily own wide ranges of buildings, and they don't have the economies of scale that other larger management companies do. That one-time expenses, a big capital event in a year, or a big change in oil price, or a big change in electricity usage or heating cost, has a significant impact on those buildings in a way that it doesn't in larger buildings. And as a general matter, maintenance expenses are going to be, on a per unit basis, are going to generally be higher in small buildings because you still need somebody to maintain the common areas and the hallways. So those are the kinds of things that we see in small buildings. I do think that the economics of small buildings are extremely challenging. One vacancy for some significant amount of time in a 6-unit building is obviously much more impactful than the one vacancy in a 50-unit building or a 100-unit building. So there are definitely challenges associated with the smaller buildings in the housing stock in New York and across and frankly everywhere. It's not just New York.
And then, so you have here the number of properties from the RGB study. I was wondering from your study, how many properties are we, maybe I might have missed this, but is it 331 that we're talking
It's
about?
331 loans that we got reporting back on, but those loans aren't necessarily one building at a time. So I don't have, Dan, I don't know if you have the actual number of buildings, but I don't have with me right now the actual number of buildings, but I would, there's very little doubt in my mind that it is, 331 plus buildings, so it's probably 500, 600 buildings total. in this group.
And then I see that we're talking about the period of 2016 and David mentioned that you were here before. Did you notice any difference between 2016 and from the couple of years before when you came, from your experience?
So if you look at this chart, it shows you both it shows you the historic numbers from, all the way back to 2017. What I can add is that we haven't seen anything in the last 2 years since 2016 that would be an anomaly. We don't see any massive increases in anything in particular since then, although we haven't finished the compilation of all of the data. So I wouldn't expect any dramatic shift for our study in 2000 when the most updated numbers come out.
Just in your analysis of the expenses, you exclude taxes. Is there a reason why not including real estate taxes?
The reason is something I alluded to earlier, which is a significant percentage of our portfolio has regulatory agreements, so a significant percentage of our portfolio is also taking advantage of some level of a tax abatement in one shape or another. It could be J51, it could be an Article 11, it could be, to show real estate taxes and then try to use that and compare that to a non-regulated stock that's paying full taxes,
Right.
would be an anomaly in the numbers.
And when you do your loans, are the majority of the units in those buildings under some sort of regulation, and whether it's rent stabilized or not, or do you have a sense of the market units that would be included in that?
The vast majority, I won't tell you that it's 100%, but the vast majority of the units that we finance are under some sort of regulation. It's either rent stabilized because it's using J51 or because it's 421A, or it's an HPD. It's in partnership with HPD, and it has, a 30-year plus regulatory agreement in place, and it's rent stabilized. So, is it 100%? I don't know, but it's some number very close to 100%. Just quickly, again, nothing, I don't think, really particularly enlightening here. I think that the trends are pretty close on some of the big, outside of taxes, some of the big expense items that we look at. I think.
One question there.
Sure.
So is it safe to say that the vast majority of your buildings are not dormant buildings?
Yeah.
Or not full-service buildings?
Yes.
So, Andrew, is that what fits into maintenance? Maintenance is the category where the two lines have some amount of divergence.
Yeah.
I think that's where the staff would fit, right?
I think there's two things here. One is significantly smaller buildings on average than probably the larger universe. So total staffing costs, are less. I think the other thing is that inside this portfolio are, a significant percentage of the buildings either recently or, in the last 20 years went through a major gut renovation in partnership with HPD. So you're going to see lower maintenance costs in that stock because the units were upgraded as part of an affordable housing program. It's probably, if I had to guess, and we could get you that number and show you that. If I had to guess, I would say it's probably 50% of our portfolio has been through some major renovation event in the last 15 years. So that would definitely, that would be the largest driving factor in why maintenance is different. On the labor side, I think it's more what you're talking about, which is it's not dormant buildings, and, oftentimes it's smaller buildings, so maybe they have a porter and not a super, that kind of differential. That being said, the trends are very similar. So the other thing that I talked a little bit about when I was here 2 years ago that I thought I would just quickly share again is kind of from an underwriting perspective, what does all of this mean, and what do rising expenses and then that equation with rents, how does that affect the underlying financing of properties? A couple things that I would say at the outside of this, pretty much every multifamily lender that I know typically, and has for my entire career, underwritten properties looking out a 30-year pro forma, and they've trended rents and expenses at 2 and 3 respectively. That's been the industry standard for 30 years. So they do that to be sure that the loan performs over a 30-year horizon. A couple things that I would say about that. One is, at CPC, we do a lot of 30-year fixed-rate mortgages. That is not true of the broader market. Much of the broader market is doing short-term, variable rate, interest-only kinds of debt, with some interest-only period payback. So, but the underwriting of those loans, whether, and a lot of that is either bank balance sheet debt or debt that is ultimately sold to the secondary market to, the GSEs or through another outlet. Those loans are all still underwritten the same way. They're underwritten with the 2 and the 3 expense increases, and they look at 30-year pro formas to see how those properties perform. So, the question then becomes, if you see dramatic increases in expenses that are unforeseen, or you see a change in how rents are able to grow over time, what happens to the economics of buildings? And so 2 years ago when I was here, we were asked to look at a specific example and try to provide some highlights. And so, again, very simplified kind of example, but we looked at a rent-regulated building in the Bronx, which we hold the debt on, 25 units total. As of the time we underwrote the buildings, 23 of the 25 had rents that were below 95% of AMI. We did our normal trending at 2.5% and 3%, and we're able to provide $2.5 million worth of financing. If you underwrote the property assuming that rents were flat, what you find is that you find two things. One is that the amount of debt that we would be able to provide if you assumed a 0% rent growth over that same period with 3% expense increase, you could provide significantly less debt, which means the owner has to come up with more equity in order to make the transaction work. And then the other thing that you find is that at a debt service coverage ratio of 1.21 in year one, when you trend that out by year 6, the project becomes unable to cover the debt service in the building. So you don't have to look out very far to see how the changes in either rising, in how rents rise and how expenses increase, to see that it has a significant economic impact on buildings.
Rafael, can we talk about that a bit?
Sure.
Just, so, when you said this 2 years ago, that kind of, when we make our decisions and votes, it kind of kept me up at night. And there was two, I think we talked, maybe you and another speaker, we talked about two populations of buildings, because we set one number for the whole system. And so the two populations of buildings were like the small mid-block outer borough rent-stabilized building with a large proportion of units rent-stabilized. And that could kind of be the building you're describing here.
That's this one.
And then you or somebody else also said, well, buildings run by not-for-profits that, they're underwritten relatively conservatively, and they're not doing big bumps in rent through other sources, MCIs or AIs or anything like that. And so if they got nothing, then that population of buildings will be hurt. Last year, we asked the staff to look at, to go more finely grained into looking at buildings like this. So buildings that are 80% stabilized versus buildings that are 20%. And they're not doing as well, but they're doing okay, and they're not a lot of buildings in distress. And then we looked at, and then we asked ANHD, which represents a lot of not-for-profit developers. They were pushing for low increases, and so just trying to get a sense, like, so this totally makes, I get this, and it totally makes sense, and yet we're not yet seeing anything like this when we look at the data that we have. Do you have any reaction? It could be the data there's a drag on the data, but do you have any thoughts as to how operators are getting by in the environment of relatively low rent increases?
I would say my number one answer, I think there's a ton of answers to the question. My number one answer is we continue to be in a decade-plus long environment of historically low interest rates. And so the ability, when I was, if you go back and you were to look and Google, my public comments when I was HPD commissioner, which was, I was appointed in February of 2009, which was not a very fun economic time, if we would all remember back to that moment. And I made a number of public comments during that period that what I was worried about was when interest rates start to rise again, buildings that have been doing short-term financing would have a hard time refinancing out into new debt. That hasn't materialized because interest rates have been kept artificially low for lots of good reasons. By artificially, I'm not making a monetary policy comment. I'm not capable of such high thinking. But that's a big factor in why you're not seeing buildings in significant distress, because you're able to keep you're able to keep you're able to get financing to take out your other financing, and it allows you to kind of stabilize the underlying financing of the properties. In December of last year, when we had a significant blip in interest rates, I started to get really nervous again, because that's a point at which you're going to start, the distress is going to become obvious. And that's primarily from my perspective, primarily for the market-based buildings. The not-for-profit buildings, I think the primary reason for the explanation is, for the reason why you yet haven't seen any distress in that portfolio, is the way they're underwritten in the first place. They are, and first of all, there is distress in that portfolio, and a lot of those properties and buildings are starting to go through renovations, the ones that were done 20 plus years ago. But they were all underwritten very conservatively. They have very small, in comparison to the overall capital stack, first mortgages. They have a significant amount of public subsidy behind it that they're paying, 0.5% or 1% interest only when they can afford to make the payment. So there's ways that they have to be able to manage flat rents or no rent increases that the rest of the world doesn't have. And I think that kind of, for me, those are the reasons why you haven't in those stocks seen any immediate impacts from, the previous rent increases. Now, I know when you guys invited me to come back, which I appreciate, you had asked whether we could provide you with any data to support all of those things that I said, and unfortunately, we just don't. We don't collect data in that way. So we looked into it, we tried to see if we could figure out something that we could show you that would be more analytic rather than my anecdotal, but we really couldn't come up with it. But, based on my history and experience, that's my best guess as to why you haven't seen it in those two populations of buildings.
I just in this particular chart, this assumes nothing happens, there's not an insurance event at the building, or someone gets hurt, or
100%.
or the building needs facade work. This is just as if
there's
you don't
no-
have to put any extra money into the building.
Correct. That's correct. Steady state. This is nothing, there's no dramatic event. There's no, fire in a unit. There's no, significant loss of income for another reason. Dramatic increase in water or sewer or some other expense line. This is just baseline.
Your buildings all built in a capital reserve fund, or your underwriting?
Yeah.
So that would potentially be accessed for those kinds of problems?
For sure. Yep, for sure. There are, all most buildings, depending on how they're underwritten and where the debt comes from, but most buildings have some level of capital reserve. But, I think, pretty much across the board, the industry standard for that is about, $200 a unit, per year. So for a 25-unit building, that's not a ton of money, built up if you have a major event.
Some things, David, some of the laws, the bed bug disclosure law, if an apartment gets a bed bug infestation, the owner's responsible for it. So that's not a capital event. I don't know if the lender would allow that to come out of a capital reserve. So that would just be an unexpected expense that would have to be handled.
That's right. Yep.
Rafael, in terms of the 2% rent increase, is that, to what extent is that the annual rent stabilized renewal lease versus, as also including vacancy increases, MCIs, et cetera?
It would include everything. It would include any way in which a building owner could get a rent increase, just like the 3% would include any, is a proxy for any, expense, increase that would happen at a building. We don't, nor do any lenders look at all of the different possible ways, right? The purpose of doing the 2 and 3 is to try to be conservative from a lender's perspective about how much debt a building can carry, so that you're not over leveraging the property.
This is just neither here nor there, or not directly related to what Rafael is saying, but Andrew and I were doing a back of the envelope calculation of what increase does the average building get from the vacancy allowance. And so if you have a 10% vacancy allowance and 10% of apartments become vacant every year, two rough estimates, that's effectively a 1% increase across the housing stock, which is kind of something I hadn't focused on until Andrew and I kind of worked it through.
Right.
So even for the relatively stable small building, or potentially even for something with a regulatory agreement, the vacancy could allow for some increase that is not in the number set by the RGB.
Yeah, that's right. That's right.
And that may change in Albany this year, but in the past years.
So when you ask for expense data, do you ask for income data as well from?
We do. We get both. We get income and expense data.
Is there anything that you've noticed from like 14, 15, 16 with income?
No, I mean, we can dig into it, Dan, I don't know, we can look at it and share it with you separately, but no, I don't think, again, given the nature of our portfolio, I don't know that we would be the right source to see any, significant income, change variations because of the significant preponderance of regulated stock that we finance. Regulated meaning outside of rent stabilization, so regulated by HPD.
So then from that, I guess we can assume that you don't have anyone in your portfolio that's in, we would call distressed, where the income is not, expenses are exceeding income. It's just the nature of the buildings you're dealing with that.
As a, well, I wouldn't say that we don't have any buildings in our portfolio that are in distress, because we certainly do, but as a general matter, we have been, over a 45-year history, very lucky in our portfolio, and we have a less than 1% default rate across our portfolio. And that's a function of a number of things. We're conservative, we're not, we are not a high leverage acquisition lender. That's not who we are. We lend to, the people that want to own their buildings for a long time.
What is your underwriting standard for debt service coverage ratio? Is 1.21
It's 1.2 or 1.25.
But so, I mean...
We'll go down to as low as 1.2, but we try to be at 1.25.
But to the extent that you could share your, the income side data that Andrew asked about, that'd be pretty interesting, because it would be, we don't get access to it would be interesting to see if your portfolio is doing pretty well in this low increase environment. That in itself is interesting.
Yeah, although I don't think you can, given the nature of our portfolio, I don't necessarily think that's a proxy for what's happening out in the broader market, because of the preponderance of 30-year fixed rate debt that we have in our portfolio, which is significant, and two, because of the preponderance of stock that is also regulated by HPD in the portfolio, that doesn't take advantage of, the various different levers in the rent stabilized world. And I don't know that we can do this, but if we could isolate the un-HPD regulated portion of our portfolio and provide you with some information on that could be, that might be more helpful, which I can see if we can do. We don't do a rent study similar to what we do on the expense side.
I got it, yeah.
So it's not like this is that it wouldn't be an off-the-shelf thing that we do every year. But we're happy to look at it and see if it's helpful and provide some information.
Thank you.
Sure.
Also, to confirm your case study and kind of the typical examples that you mentioned in terms of underwriting at a 2% annual increase and 3% expenses, that would be on the residential only. It wouldn't include any cross-subsidy from retail or commercial rents?
That's correct. That's on the commercial income is underwritten differently depending on, the kind of project. And we have a separate, so we also typically do a 5% vacancy allowance on the residential, and we would have a separate vacancy allowance on the commercial, depending on the location and the market conditions and all of those things.
Could I change the subject a little bit? So something that we've struggled with for the 3 years that I've been on the board is, so we know that, sorry, the light's in my eye, so I'm kind of looking down. The expense ratio is 59% now for the rent-regulated stock overall, and there's the black box of the 41%, and that could include debt service, it could include profit, it could include major capital improvements, and it can include improvements that you cannot use, that you cannot treat as either as an operating cost or as a capital improvement. So, like sometimes owners face things that they can't put into either the bucket of operating and maintenance or in the bucket of capital, of major capital improvement. We have this big fight every year between the tenant reps and the owner reps, as, the tenant reps say, that's 41% profit. The owner reps say, that's debt service coverage ratio and unreimbursed expenses from other sources. We don't have, and the staff has not been able to kind of model what that 41% looks like. Do you have any thoughts about the 41%? Like, what is the, so obviously there's a big difference between acquisition debt and cash out refi debt. But when we think about that 41%, trying to kind of calculate what portion of that is really acquisition debt, debt service, is kind of a black box to us. Do you have any thoughts about that?
Well, I'm thinking about the math question, which it's an interesting question, because I do think that there should be a fairly transparent way to think about how much of that 40% is debt service. Then the question becomes, is all debt service created equal? And I think my opinion would be that's a pretty slippery slope. I will tell you, in my experience, 30 years doing this and being in the affordable housing and multifamily world in New York, the vast majority of owners that take cash out use it to either, one, make improvements in the building that they're taking cash out of, or two, to make an investment in another building or another property. They're just...
I'm sorry, I'm just going to interrupt on that point. So what the tenant reps say about that is, well, if an owner is taking it out to invest in another building, that's effectively profit from the tenant perspective. That's you're using revenue from building one to increase your wealth by buying building two. That's an argument that's made. So I just wanted to put that out there.
I mean, but you're putting that money into another, fixed real estate asset that you're then going to operate and run, as rental housing. So it's all part of the same economic system that is impacting the housing quality and the rental market in New York. So to me, that's just different than if, people were taking out, cashing out tons of equity and, we're buying, fancy cars and boats and taking vacations to, exotic places. And that just is not what we see. We typically see a cash out, and then behind that, there's another property that comes right in, or it's a cash out in quotes, but as part of the underwriting, some portion or significant portion of that cash out is going back into property. We do a lot of refinancings where there's a cash out, but then there's physical needs in the building, so the cash out is escrowed and then put back into the building for the repairs to be made as required by the capital source, the lender, whoever the lender might be. So I think if you start to parse that, I think it's a very challenging argument. And again, I come to this from the perspective of there are clearly challenges and problems and bad actors. And when I was at HPD, one of the things that I focused much of my time and attention on was cracking down on bad actors. But I don't think we should be setting housing policy based on, for the whole city, based on bad actors. I think that's a challenged policy-making model. But that's the perspective I come at it from. It's not right or wrong, it's just my perspective on it.
So if you, I'm sorry, go ahead.
You can finish your question.
So if you were underwriting an acquisition for your portfolio, what percentage of the revenue stream for year one would go towards debt service? What would it look like? Let's say 60% is expenses. What percentage of it would be debt service?
Well, I mean, it's hard to say exactly, because it depends on a whole bunch of, factors. Look, there are owners who come to us and say, I'm acquiring this building, but I only want this amount of debt. So in that situation, they're putting up more of their own equity. They're not leveraging it as much. There are other owners who want maximum 80%, loan to value debt, and then you figure out whether you're willing to maximize the leverage on a particular building. But at the end of the day, there has to be cushion in the debt coverage ratio. You're not going to do it one-to-one. You're not going to soak up all of the income to pay debt.
My question is, do you track actually when there's a cash out? Do you track, is the question being made as to what the funds will be used for? Whether to do a major repair or to actually invest in a new property?
We don't make that, there's no mechanism for us to make that a requirement, that we know what's happening with the proceeds. So I'm just sharing experience with you of what we see in our business, where there's a lot of reinvestment in the existing building, and there's a lot of investment in the housing stock, in other buildings. But we don't have any right, frankly, to know where the money's going, unless there are actual physical conditions in the building that we're providing a mortgage on that need correcting. And then we can dictate how much of the equity that's being cashed out has to go back into the building.
So I guess I'm following up on David's question. So looking at this case study example, just, the debt service is about 38% of the total operating income, combined debt service and operating costs about 92% of operating income. The question is, can you say how typical representative this case study might be of the non-HBD stock, or is it really too variable?
This is so to my point earlier, this is a max leverage building, right? And so in today's interest rate environment in New York City, this is the majority of what we see, because people can borrow at relatively low rates, and that's, for them, that's better than using their own cash. So that's this structure is the majority of what we see in New York City today. But that's not all, that isn't always the case. The economy moves up and down, and so we have lots of loans in our portfolio that aren't anywhere near this max leverage point. And so when we see owners, we go to owners now, they have loans in our portfolio, and they might be paying 6.5–7% interest on a 30-year fixed rate loan, and they're 15 years into that loan or 20 years into that loan, and we will go to them and say, it's a good time to refinance. In those cases, which is not this example, oftentimes all they want to do is refinance the amount of debt they have now. They don't want to add new debt to the building. And sometimes they can't because of HPD or other regulatory restrictions. So it is a mix, but on new properties, new buildings that are being acquired by somebody, this is the max leverage model, and that at an 80% LTV. So, by the way, that's max leverage for us. That's not necessarily max leverage for every lender in the marketplace. There are some people that can go higher.
But this mathematically, though, is 33 cents of the 40 cents.
That's right.
What's your 33 cents?
The debt in this scenario is, if you have the 60-40 ratio, 40% is the NOI, 33 cents on every dollar, or we're doing 60 cents on every dollar are expenses to run a building, 33 cents are the debt.
Are
There's
you looking at
7
year
cents
one, or
left
you're looking
over.
at year, what year are you looking at?
Well, the debt's constant through all the years, so I did year one, but
Wait, but I got 38% and total expenses is 53%. Am I wrong? Are my numbers wrong? I got, didn't you get 38%? 137 over 355 is 38%, right? And then total expenses, 190 over 355 is, I think, 53%.
The expenses are 53%.
Yeah. So this
This case.
This is just helpful for, I mean, I'm just kind of thinking out loud, because it's actually, 'cause this is the kind of the first time I think we've kind of really kind of grappled with this. So this is like a from a conservative lender, a maximum LTV, and it's, the numbers are not exactly the same as the RGB numbers, but, you have 53% total expenses, you have 38% debt service, you leave 9% for, so does total expenses include just operating and maintenance? It doesn't include unexpected capital expenses?
It does not, and the other thing that I do not know, and Dan, I don't know if you know, whether total expenses in this case includes taxes, or whether this is a tax-abated building. It's tax-abated.
So it's just kind of interesting, I think, for the public members in particular, because there's really, listening to the owners and listening to the tenants, we're so torn about that 40%, but kind of this as an example is kind of an interesting thing that, what in a, and this is, I guess, a relatively aggressively funded, or a loan that's relatively aggressive, but there's not this humongous amount of excess after normal debt service coverage is taken into account. Normal acquisition, I'm sorry, I'm thinking out loud, maybe I'm not being super clear, but that 40% has been a black box for us, and this is a very interesting conversation about what's inside that 40%.
Yeah, I mean, look, and in buildings that are being acquired, or where they're thinking about maximum leverage, this is what you're going to see. Most of the net operating income after expenses is going to go to debt service.
With potentially a return in the single digits. Like, this is have a 9% return if there's no capital expenses.
Yeah. What I don't know here is, yes. Yes, that's right. We gave you the operating side of the analysis. I said I don't have it in my handy what the value side of the analysis is. In other words, what's the acquisition price, how much equity is going in. So it's hard to calculate a return, but.
Okay, that's right, that's right,
But, look, there's, in this model, there's $25,000 left over at the end of the year. So whether that's a 15% return or a 5% return, it's not.
It's in the same range.
It's not a ton of money.
Yeah, that's helpful.
And this is on a tax-abated building. So if you put taxes into this equation, it becomes even more challenging, because the debt amount goes down, which means the equity contribution of the owner has to go up in order to make the numbers balance. And that just makes the economics even more challenging.
Which would impact the price ultimately. I mean, that would lower the acquisition price. I mean, if the...
You would think it would, but it doesn't necessarily.
Okay.
It doesn't necessarily, because there's, one of the challenges in the housing stock right now that the Rent Guidelines Board and legislators in Albany and others are not ever, whatever changes are made, whatever you guys do, are not going to really affect the fact that there's a lot of money looking to invest in New York real estate right now. And people are willing to buy real estate at acquisition numbers that don't necessarily go up and down as you would normally expect. That being said, this is a moment in time. I've been doing this for 30 years in New York. It has not always been that way, and it will not always be that way. And that's the important thing for us to remember. So.
Any more questions from the board or comments from the board?
So just just with this example, so year 6 is where the debt service exceeds NOI, but where would you say that other parts of running the building are hurt? Like, what year are we talking, like, if you're year 3, when you're at 1.12, are owners, at what point are owners not keeping up the building? I
The
mean,
last thing a typical owner will do is not pay their mortgage.
Right, right. The rule is like, you got to pay real estate
So-
taxes and debt service.
You gotta pay your
right?
mortgage. So that's the last thing that an owner would not pay, is real estate taxes and mortgage. So, but what I would say to you is that it's likely that the year is the same. So in this year 6, where you go below 1.0, your expenses, what you're gonna do is you're gonna fund your expenses first, right? So you're not, in the years where you have at least some coverage, you're able to pay, so what doesn't get paid is any return to the owner in this model.
Gotcha.
Andrew, I mean, in year 3, it gets to 17,000. So in answer to my kind of question earlier, if something happens, like
Yeah.
an employee gets injured and the building has more expense because of that, or there's a bed bug infestation, or there's something that happens in the building, the building is in the zero, or potentially in the negative. So that the owner at that point is already in that, if something, God forbid, happens early in the year, they're already making decisions to not spend on certain maintenance costs.
1,000% right. And that does happen.
Rafael, what early indications of distress do you see in your, like you said, you have 1% distressed properties. Any signals of distress that you kind of track, or is it just like kind of it pops out?
No, I mean, look, the primary thing that we inspect buildings, we get income and expense, and we get our payments. So what we look at is inspections for physical condition, and, there are always issues in a portfolio as big as ours, but there's nothing that I would call a significant trend on the housing quality side. So far, our delinquencies haven't spiked. What we have seen is, if you were to go back and look at attrition rates out of our portfolio, so they refinance with somebody else, if you go back and look at that, I'm almost certain that is up. We're seeing more buildings leave our portfolio because they're refinancing with somebody else.
To a lower variable rate mortgage?
To a lower variable rate mortgage.
That's kind of an example of looking for a riskier solution.
Well, it's what they have to do, I would argue, to make ends meet. Would be the reason that I raise it, is that
It's a short-term fix to a problem.
It's when I think about that, I think about, why are they doing that? They're doing that because they're getting squeezed here and they need to find a way to lower their debt service. Now, that's anecdotal, that's my hunch. I don't have any data to prove that. I just have, my experience. So when you ask, like, is there anything in the portfolio that I look at that I say, there's something going on there, that's what it is. And I think in general what that is interest rates are still historically low, and, buildings are getting harder and harder to run and operate, and people are looking for ways to be able to lighten their debt load. By the way, it's the same exact decision that homeowners make. If you have an ability to refinance your mortgage, you refinance it because it lightens your debt load. There's nothing else going on than that.
This is a different topic. Do you see any trends in terms of sales of your buildings and the types of owners of the buildings that buy them?
You know, when you say trends, I get nervous because it's anecdotal based on kind of the portfolio that we see. A year ago, we were seeing a lot of acquisitions, a lot. We're not seeing nearly as many acquisitions today. We're seeing refinancings. Why is that? I don't really know. The one hunch I have is that the debt, the spike in interest rates that happened at the end of 18, I think got a bunch of owners' attention, and they want to refinance and take advantage of the low interest rate environment to do that. I think the uncertainty around rent stabilization is probably what's depressing acquisitions at some level. But a year ago, or a year and a half ago, we were seeing lots of acquisition activity, and we're seeing less of it now.
And when there was an acquisition, would the new owner borrow from you as well, or they tend to take a...
Yeah, no, that's what I mean. When I see we're seeing a lot of acquisition activity, it was new loans, incoming new loans. What were the nature of the new loans that we were making? They were predominantly acquisition a year and a half ago. Today, they're much more predominantly refinancings. Whether it's refinancing of our portfolio or refinancing of a mortgage from somebody else, we're seeing more refinance activity than ever before. We're also, by the way, this is an interesting anecdote, we're seeing more people coming to us. We are an FHA lender, so we're seeing more, for the first time in my 30 years doing this, people are looking to do FHA refinancings, locking in 35-year fixed rate, low interest debt on their buildings. Personally, I think that's a good trend, and these are all 100% rent-regulated buildings, and they are either still in some level of HPD or state regulatory structure, or they're just exiting it. But they're not. They're looking to lock in debt, even though they're exiting the HPD regulatory agreement. Again, we do very little in Manhattan. We do very little on the Brooklyn waterfront, Queens waterfront. We're not playing in those markets. We're playing in different markets. So that's part of why that's a trend we're seeing. But I'm not saying it's being repeated with other people, but we're definitely seeing it.
I think as a clarification to Alex's question, when one of your owners sells their building, can the financing stay with it, or does it typically stay with it, or does it, or can it, I guess, is the first question. And then if it can, do people exit it or they keep it?
The answer, well, in today's environment, most people will not choose to keep the financing. Depending on the source of financing, some of the debt that we do is assumable, some of it is not assumable. In today's interest rate environment, almost nobody is going to choose to assume debt on existing debt, because they can do better. Generally speaking, they can do better with new debt.
So
and they want more. Sorry, and they also want more debt, because they don't want to leave an amortized, loan in place. They want to increase the debt so that they can do whatever they need to do.
So the takeaway of our discussion this morning, what I'm hearing, and maybe I'm wrong, but as long as the lending market stays the way it is, where the interest rates are lower, our modest or low guideline increases have been sustainable over that time. The warning is, if we see it in terms of what you do, if we start seeing interest rates rise, then there may be some indication that our what we do may have to be, we may have to reconsider what we're doing.
I want to be very careful about a takeaway like that. Our portfolio is interesting, and provides some, I think, helpful information, but the fact that we have not seen any distress in our portfolio because of the last, few years of low or no increases, I do not think the takeaway is that those are sustainable to the broader market. That would not be my takeaway. It would be that this one kind of unique, quirky portfolio from a nonprofit lender who does a lot of stuff in the outer boroughs, it hasn't had a huge impact yet. Most of the buildings are have tax abatements.
Right, well, and that's what I'm putting in the context. I'm not trying to,
I wanna
I'm not
be
trying to
careful.
put
I
it
just
to
wanna
the
be
rest. I'm
careful.
saying
That's-
from what you're dealing
That's
with.
this portfolio. We have not seen any, dramatic impact. The last part of your comment is 100% true. And there, if you, depending on who you talk to, people will tell you that, November, December of 18 was a blip, and, the Fed is now saying they're not going to increase interest rates. I'm not an economist, I'm not smart enough, but I think it continues to be at some point, what I would argue is that we have to stop, and this is not just Rent Guidelines Board, this is the entire multifamily housing market in New York. We have to stop relying upon extremely low interest rates to generate, that are artificially low, to generate real estate activity. That makes me nervous about the system overall.
So I'm going to push, and you don't need to agree with me by any stretch of the imagination, but from my takeaway of what you said is, here we have a portfolio of outer borough, no commercial properties, with owners that are not necessarily looking to jack up rents dramatically, because a lot of them are under regulatory agreements, and they have not had distress. So it's like I don't want to say it's a poster child for a pretty conservative portfolio, but it kind of does seem a little bit like a poster child for a pretty conservative portfolio. In other words, where the owners, for one reason or another, don't have a lot of opportunities or desire to jack up rents. In other ways, through MCIs, through vacancy decontrol, through all those other mechanisms.
As a general matter, the borrowers that come to a place like CPC, their business model is what I would describe as old school. It's, we buy and hold for the long run, and it's a long-term real estate investment, not a short-term play with other people's money. That's not who borrows from us. So I agree with you from a conservative portfolio perspective.
Rafael, this was, again, incredibly helpful. Thank you so much. This is super helpful.
I hope so.
Thank you.
I wish I had more answers, but it is.
That's always our problem. Lots of questions, no answers.
Thank you. Thank you for doing what you do. Somebody has to. More paper, but.
Okay, thank you.
So someone else has the conference room at 12, so do I hear a motion to adjourn? Do I have a second?
Second.
We're adjourned. Thank you so much.